Question number 1. Davis, CPA, has substantial doubt about Alder Co.'s ability to continue as a going concern for a reasonable period of time. In assessing Alder's plans to address the effects of adverse future conditions, Davis would most likely regard which of the following as a mitigating factor? Letter A. Speeding up research and development projects tied to future products. Letter B. Buying back treasury stock at prices favorable to Alder's historical range. Letter C. Purchasing equipment and production facilities that are currently leased. Letter D. Negotiating a reduction in the dividends required on preferred stock. Correct answer is letter D. Explanation. Letter D is correct because negotiating a reduction in the required preferred stock dividend directly reduces cash outflows, which helps address the going concern issue. Speeding up research spending, buying back treasury stock, and purchasing leased equipment all consume cash rather than preserve it, so none of them qualifies as a genuine mitigating action. Question number 2. Under which of the following circumstances would a disclaimer of opinion not be appropriate? Letter A. The auditor cannot determine the dollar amounts involved in an employee fraud scheme. Letter B. Management fails to provide reasonable justification for a change in accounting principle. Letter C. The client will not allow the auditor to confirm certain receivables or apply alternative procedures. Letter D. The Chief Executive Officer refuses to sign the management representation letter. Correct answer is letter B. Explanation. Letter B is correct because when management cannot justify a change in accounting principle, the proper response is a qualified or adverse opinion, not a disclaimer. The other three situations are all scope limitations, meaning the auditor could not gather enough evidence, and scope limitations are exactly the kind of problem a disclaimer of opinion is designed for. Question number 3. For which of the following events would an auditor's report omit any reference to consistency? Letter A. A change in the method used to account for inventories. Letter B. A change from an accounting principle that is not generally accepted to one that is. Letter C. A change in the useful life used to compute depreciation expense. Letter D. Management's failure to provide reasonable justification for a change in accounting principle. Correct answer is letter C. Explanation. Letter C is correct because changing the useful life used for depreciation is a change in accounting estimate, not a change in accounting principle, so it never triggers a consistency reference in the first place. The other three choices all involve a change in accounting principle, and any change in principle does call for a consistency modification. Question number 4. When an entity changes an accounting principle in a way that materially affects comparability, and the auditor concludes the change is appropriate, which of the following must the auditor's report include? Letter A. An explanation of why the change in principle is justified. Letter B. A description of the cumulative effect of the change on prior year's results. Letter C. An explicit statement that the auditor concurs with the change. Letter D. Identification of the nature of the change, with reference to the financial statement note that discusses it. Correct answer is letter D. Explanation. Letter D is correct because the auditor's report simply needs to identify the nature of the change and point the reader to the financial statement note that explains it in detail. The auditor does not need to justify the change, describe its cumulative dollar effect, or state explicit agreement with it inside the report itself. Question number 5. During the first audit of a new client, an auditor extends procedures enough to gather sufficient evidence about consistency. Under these circumstances, the auditor should: Letter A. Decline to report on the client's income statement. Letter B. Make no reference to consistency in the auditor's report. Letter C. State that the consistency standard does not apply. Letter D. State that accounting principles have been applied consistently. Correct answer is letter B. Explanation. Letter B is correct because once the auditor has done the extra work needed to be satisfied that accounting principles were applied consistently, even on a first-year audit, the report simply says nothing about consistency at all. It does not affirmatively declare that principles were applied consistently, and it does not claim the standard is inapplicable. Question number 6. In which of the following situations would an auditor most likely add an emphasis of matter paragraph to an otherwise unmodified opinion? Letter A. The auditor is engaged to report only on the balance sheet, not the full set of statements. Letter B. Substantial doubt exists about the entity's ability to continue as a going concern. Letter C. Management's estimates of future events appear unreasonable. Letter D. Certain transactions cannot be tested due to a records retention policy. Correct answer is letter B. Explanation. Letter B is correct because substantial doubt about an entity's ability to continue as a going concern is the classic situation that calls for an emphasis of matter paragraph added onto an otherwise unmodified opinion. The other situations either need no added paragraph at all or would call for a different kind of report modification entirely. Question number 7. Would an auditor express an unmodified opinion with an added emphasis of matter paragraph for each of the following: an unjustified change in accounting principle, and a material weakness in internal control? Letter A. Unjustified accounting change, yes. Material weakness in internal control, yes. Letter B. Unjustified accounting change, yes. Material weakness in internal control, no. Letter C. Unjustified accounting change, no. Material weakness in internal control, yes. Letter D. Unjustified accounting change, no. Material weakness in internal control, no. Correct answer is letter D. Explanation. Letter D is correct because neither situation results in a simple emphasis of matter paragraph. An unjustified accounting change actually leads to a qualified or adverse opinion, which is a much stronger reaction than an emphasis paragraph, and a material weakness in internal control ordinarily does not modify the opinion on the financial statements at all. Question number 8. When management does not provide reasonable justification that a change in accounting principle is preferable, and comparative financial statements are presented, the auditor should express a qualified opinion. Letter A. Only in the year the accounting principle changed. Letter B. In each year that the financial statements initially reflecting the change are presented. Letter C. Only until the entity reverts to the previously used accounting principle. Letter D. Only if the newly adopted accounting principle is not, in fact, generally accepted. Correct answer is letter B. Explanation. Letter B is correct because the qualification must continue to appear for every year that the financial statements reflecting the unjustified change are being presented and reported on, not just in the single year the change first happened. The qualification does not simply expire after 1 year or wait for the entity to switch back. Question number 9. The adverse effects of conditions causing an auditor to have substantial doubt about an entity's ability to continue as a going concern would most likely be mitigated by evidence relating to the Letter A. Entity's ability to expand into new product lines in the future. Letter B. Feasibility of buying leased equipment below its market value. Letter C. Marketability of assets management intends to sell. Letter D. Existence of arrangements to convert preferred stock into long-term debt. Correct answer is letter C. Explanation. Letter C is correct because if the assets management plans to sell are genuinely marketable, that provides real, obtainable cash to relieve the going concern doubt. Expanding into new product lines, buying leased equipment below market, and converting preferred stock to debt are all speculative or still require resources the entity may not actually have. Question number 10. Vantage Company costs its international subsidiaries inventory using FIFO and its domestic inventory using LIFO. Under these circumstances, the auditor's report on Vantage's financial statements should express N. Letter A. Unmodified opinion. Letter B. Opinion qualified for a lack of consistency. Letter C. Opinion qualified for a departure from GAAP. Letter D. Adverse opinion. Correct answer is letter A. Explanation. Letter A is correct because using different, individually acceptable inventory costing methods for different portions of inventory, such as one method abroad and another domestically, is permitted under generally accepted accounting principles as long as it is properly disclosed. It is neither a lack of consistency between periods nor a departure from GAAP, so an unmodified opinion is appropriate.